The term everything bubble reflects the current state of global markets. Assets across various sectors, from stocks and bonds to real estate and cryptocurrencies, have experienced a prolonged period of inflated prices. This surge is driven by factors like low interest rates, easy monetary policies, and speculative investing. However, warning signs are emerging, suggesting this bubble might be on the verge of bursting. Economic indicators point towards a potential recession, fueled by global trade tensions and underlying weaknesses in major economies. The everything bubble signifies a precarious situation where a market correction could have widespread and severe consequences. The global economy is grappling with a confluence of factors that heighten the risk of a recession. Trade wars and protectionist policies disrupt supply chains and dampen international trade. Manufacturing activity is slowing down, and consumer confidence is waning in the face of economic uncertainty. The ongoing conflict in Ukraine and geopolitical instability further exacerbate the situation. These factors contribute to a fragile economic landscape where even a small shock could trigger a downturn. The possibility of a recession poses a significant threat to the stability of the everything bubble, as asset prices are likely to plummet when economic activity contracts. Despite the looming recessionary pressures, consumer spending remains surprisingly robust. Unemployment rates are also at historic lows, partially attributed to the rise of automation and AI-driven job creation. This seemingly positive economic picture creates a paradox. While consumers continue to spend and unemployment remains low, underlying economic indicators paint a different story. This discrepancy raises concerns about the sustainability of the current situation. Is the strength in consumer spending and employment masking deeper structural problems in the economy? The answer to this question holds significant implications for the future trajectory of the everything bubble. The housing market, a key pillar of the economy, is facing significant headwinds. Mortgage rates have surged to multi-year highs, making homeownership less affordable for many. The combination of high prices and rising interest rates has dampened demand, leading to a slowdown in sales and new construction. Investors who were once eager to capitalize on the booming housing market are now pulling back, fearing a potential bubble burst. The cooling housing market is a red flag for the broader economy, as it can have a ripple effect on consumer spending, construction employment, and overall economic growth. The current state of the housing market suggests that the everything bubble might be losing steam. Government debt has reached alarming levels in many countries, fueled by years of deficit spending and the need to combat economic crises. This mountain of debt poses a significant threat to economic stability. As interest rates rise, servicing this debt becomes increasingly expensive, diverting resources away from essential public services and investments. The rising cost of debt can create a vicious cycle where governments are forced to borrow more to cover their interest payments, further increasing the debt burden. This unsustainable fiscal trajectory adds another layer of vulnerability to the everything bubble. If investors lose confidence in a government's ability to manage its debt, it could lead to a sovereign debt crisis, triggering a domino effect across the global financial system. A key characteristic of the everything bubble is the prevalence of high market valuations. Across various asset classes, prices appear disconnected from underlying fundamentals. Stock markets are trading at elevated price-to-earnings ratios, indicating that investors are willing to pay a premium for future growth expectations. However, these expectations might be overly optimistic, especially in light of the economic headwinds discussed earlier. When valuations become stretched, markets become more susceptible to corrections. A correction occurs when asset prices fall sharply, often triggered by a change in investor sentiment, negative economic news, or a combination of factors. The current disconnect between market valuations and underlying fundamentals suggests that a significant correction in the everything bubble is not only possible but increasingly likely. Wall Street analysts, often known for their bullish outlook, continue to issue optimistic projections for corporate earnings and market performance. However, these rosy forecasts stand in stark contrast to the historical data and current economic realities. Corporate earnings growth has been slowing down, and the factors that have supported asset prices in recent years, such as low interest rates and quantitative easing, are being withdrawn. History teaches us that periods of excessive optimism and speculative exuberance are often followed by painful market corrections. While predicting the timing and severity of such corrections is challenging, the current divergence between Wall Street's projections and historical trends raises concerns about the sustainability of the everything bubble. Prominent economists and financial experts have been sounding the alarm about the risks associated with excessive debt levels, asset bubbles, and unsustainable economic policies. These warnings, often dismissed during periods of market euphoria, deserve careful consideration. Experts point to historical parallels, such as the 2008 financial crisis, as a reminder of the devastating consequences that can unfold when asset bubbles burst and financial systems come under stress. They emphasize the need for prudent fiscal and monetary policies, structural reforms to address underlying economic imbalances, and a shift towards sustainable investment strategies that prioritize long-term value creation over short-term speculation. In times of heightened uncertainty and market volatility, investors often seek refuge in strategies that emphasize safety, value, and income generation. Value investing, a philosophy championed by legendary investors like Warren Buffett, focuses on identifying undervalued companies with strong fundamentals and holding them for the long term. Dividend-paying stocks, particularly those with a history of consistent dividend growth, can provide a steady stream of income and act as a buffer against market fluctuations. By prioritizing investments in companies with a proven track record of profitability, sound management, and a commitment to shareholder value, investors can navigate the challenges posed by the everything bubble and position themselves for long-term success. Subscribe and click that notification button for more financial information weekly.